The stock market fell again on Wednesday, once again closing at the lowest level in over a month. And this is leading many people to wonder, when will the stock market recover? Historically, August is a flat month for the stock market. And with the stock market now down over 5% on the NASDAQ and the S&P down over 3% as well, people are starting to wonder if we are going to have a flat August. Are we going to turn around and get back up to flat? Is the NASDAQ going to rally 5% over the next 2 weeks? Is the S&P going to rally 3% over the next 2 weeks? Well, a lot of the data that came out yesterday, and including the data today, is starting to indicate that maybe it won't. We might not actually recover and start to rally once again until October at the earliest. And this is making Michael Burry's put options look like a genius play. If you're not familiar with who Michael Burry is, he became very famous for first realizing that there was going to be a major collapse in the housing market back in 2005. He ended up placing short bets on the housing market in 2006, and starting at the end of 2007, beginning of 2008, that short position ended up paying off. Being that Michael Burry is one of the earliest people to actually realize this, he is very often labeled as sort of this contrarian, really smart person who can see downturns in the market. Now, one thing to keep in mind is Michael Burry is always predicting a downturn in the market, and he has correctly predicted at least 2 or 3 of the past 28 downturns that he's predicted. So you gotta take his assumptions of a downturn in the market with a little bit of a grain of salt. And with that, we got to talk about these put options he placed, because you may have seen the headlines where Michael Burry placed $1.6 billion worth of put options. Well, what you have to understand is that was based upon what was reported on a Schedule 13F. Schedule 13F is just something that gets reported to the SEC once a quarter to show what a particular firm is invested in. And the thing you have to understand about options when they get reported on a 13F is that the option is reported at the notional value. But when you buy an option, you're buying it for 1/100th of the price. So the amount of money that Michael Burry actually paid for those was not $1.6 billion. It was probably $16 million or less. So that is one thing to keep in mind. And it's very important to understand when you're trying to understand whether his bearish position is an actual bet that the market's going to go down, or if it's just a hedge. The difference between a hedge and a bearish bet is that a bearish bet is where you're placing a downward trade in anticipation of making money from that downward move in the market or downward move in the stock. A hedge, on the other hand, is when you have a large portfolio of long positions, that is, you own a bunch of stocks, and you want to protect yourself against a possible turn to the downside. And it appears that's what Michael Burry was actually doing, because his total portfolio is over $100 million, but he only bought about $4 to $16 million worth of put options. So given the very small amount of put options compared to the fact that about 90% of his portfolio is actually long, this actually indicates that more than likely Michael Burry's short position was a hedge. It was a protection against a possible downturn in the market rather than a bet that the market was going to go down and an attempt to make a huge amount of money. So keep that in mind when you see all these headlines about Michael Burry. This is most likely a hedge, not an actual bearish bet. And especially as the market goes down, hedging your portfolio is a good thing to do. Maybe buying just a small amount of put options on the overall market, maybe a small amount of call options on VIX, which will go up as the market goes down. Maybe some SQQQ or SPXU, which are ETFs that go up as the market goes down. These are all different ways of hedging your portfolio against a possible downturn. And given the fact that the market just continues to drop, it's probably a good idea to go ahead and hedge your portfolio to help recover any losses in your long-term investments. Now, with all of that said, let's talk about why the market keeps going down and some of the news that came out today. Well, we get things started with the news that came out of the UK. UK headline inflation dropped sharply to 6.8% in July from 7.9% in June. Now, the drop in headline inflation is really good news. You want to see inflation going down. The thing to keep in mind is that central banks really need their inflation to get down to 2%. So this means that the bank in the UK is most likely going to have to continue to raise interest rates. But the UK is actually facing a bigger problem. Pay growth continues to pose headaches for policymakers as wages, excluding bonuses, grew by 7.8% year over year, which is the fastest growth rate since records began in 2001. That means that in the UK, wages are going up more than inflation is going up, and that is what's known as a wage price spiral. And it is a death sentence to an economy because what ends up happening is wages go up. And then as wages go up, people have more money to spend. So inflation goes up. As inflation goes up, the wages go up to match the higher inflation. That causes more spending, which causes inflation to go up, which causes more wages to go up, which causes more spending, which causes more inflation, which causes wages to go up. And it's a spiral. It just goes up and up and up and up with no end in sight. And if the Bank of England cannot get this under control, then they're going to be dealing with hyperinflation very soon. So this is a huge problem for the UK that they're going to have to get fixed, and they're going to have to fix it fast. And that means that the Bank of England will probably determine that more interest rate rises are required in order to get the job done. And as we've already seen here in the United States, interest rate increases, while they're good for bank profits, they're also a double-edged sword because they increase the amount of loan losses. And if consumers go out and start pulling money out of banks, that ends up resulting in bank collapses. So while the rising interest rates are good for banks in the short term, they pose a huge risk of bank collapses. And we could end up seeing more bank collapses in the UK, just like we saw here in the United States, as well as elsewhere with Credit Suisse. And this could pose major problems for the worldwide economy. So this is definitely something that we're going to have to keep our eyes on. I know as a U.S. investor, you might not look at the UK that much. You might not care what's going on in the UK, but you should be, because the problems in the UK have a tendency to spread throughout the world. Now moving on to some individual stock news. Tesla made further price cuts in China, reducing their Model S and X by $7,400 to $8,500. Are you kidding me? That's like cutting the price of the car in half. Tesla is trying to boost sales by cutting prices, but as they attempt to compete against the other manufacturers in China, this cutting of prices, really all it does is significantly cut into Tesla's margins. And we have seen this before. When those Tesla margins go down, it hurts earnings. It hurts profits. And shareholders do not like this. Tesla stock was down over 3% on the day on this news. In other EV news, Vietnamese EV maker VinFast is now worth more than Ford and GM after its NASDAQ debut. VinFast went public via a SPAC deal. Now, SPAC deals have a long history of rising up significantly right before the merger, and then right after that merger occurs, the stock sells off tremendously. And this was no different. The stock rose 270% going into the merger this morning, but the second that merger hit this morning, the stock sold off. VFS was down almost 19% on the day and another 4% after hours. Now moving on to earnings, ZIM reported their financial results for the second quarter of 2023. And I'm going to tell you right off the bat, the earnings were not good. ZIM stock was down over 10% today. Net loss for the second quarter was $213 million, or a diluted loss per share of $1.79. That is a massive loss. Adjusted EBITDA for the second quarter was $275 million, a year-over-year decrease of 87%. Operating loss for the second quarter was $168 million. Revenue for the second quarter was $1.3 billion, a year-over-year decrease of 62%. It was an absolutely horrible quarter for ZIM. But why was the quarter so bad? Well, the biggest reason is because the average freight cost was down 67% year over year. Now, this was to be expected. We saw shipping rates rise significantly in 2021 and well into 2022 before they dropped sharply towards the end of 2022, and they continue to drop through this day. And that is why we're seeing a big decrease in the profits on ZIM, as well as all shipping companies across the world. But the real question I had is, we knew the decrease in shipping costs were coming. We knew that profits were going to go down. We knew revenues were going to go down. We knew all of that going into earnings. The question is, how was ZIM's actual amount that they shipped, and what moves did they make to improve themselves in the future? Well, the one thing that I liked is that carried volume in the second quarter was 860,000 units, a slight year-over-year increase. What that means is that even though shipping costs have gone down, which have reduced ZIM's revenue and profits, the amount of containers that they're actually shipping has gone up, which means their business is growing. Yes, I know revenue is down because shipping costs are down, but the business overall is still growing. And that means that once things turn around, once shipping costs start going back up again, their profit should go up as well. Now, ZIM, in addition, also loves to make some special moves when things get really bad in the market. And this is actually one of the things I love about ZIM. Eric Glickman, ZIM president and CEO, said that as the year progresses and into 2024, we expect our cost structure to improve in tandem with the delivery of our highly competitive, fuel-efficient, new build tonnage, including 28 LNG-powered vessels. So one of the reasons that ZIM's profit was down so much is because they purchased 28 new ships. Now, this is huge. This is what ZIM does all the time. They did it in 2020 when things got really bad. In 2020, when everything shut down, nobody was shipping anything, ZIM looked at the downturn in the market. They looked at the huge discount on shipping prices on new ships, and they went out and bought ships dirt cheap. What this did is it meant that when things turned around in 2021 and 2022, ZIM made a killing. Their profits were through the roof. They made a ton of money. The stock skyrocketed in price. The dividends were enormous. And it was an incredible time to own ZIM stock. Now things have turned around. Now we're back to kind of like where we were in 2020, where the shipping prices have gone down, profits are down, and guess what? The cost of ships is down significantly as well. And just like ZIM always does, they're taking advantage of this time period. They're buying new ships so that when things turn around, they're going to be able to make a ton of money. This is ZIM's MO. This is how they operate. They go through these boom and bust cycles. Now, whether you decide to hold ZIM during this time period and add on to ZIM so that you are ready to make a ton of money when things turn around, or if you decide you've had enough, you can't handle it anymore, and you just want to get out, That's entirely up to you, and I can understand both viewpoints. There were people in our coaching program today who sold ZIM, and there were other people in the coaching program today who bought more ZIM. So I completely understand both viewpoints. It just depends upon how long of a time horizon you have on ZIM. If your time horizon is very long, then there's an incredible opportunity to make money. But if your time horizon is a little bit shorter, it's probably a good time to get out. ZIM CEO added that although our second quarter results reflected continued near-term challenges in the container shipping market, our total cash position of $3.2 billion at quarter's end remains strong, and we believe our ample liquidity and strong balance sheet will enable ZIM to operate from a position of strength and maintain a long-term view even during a prolonged period of market weakness. Based upon a soft peak season and demand that is expected to remain subdued for the remainder of the year, ZIM forecasts full-year loss of $500 million to $100 million in 2023. What that means is that ZIM stock will most likely continue to struggle through the remainder of the year and most likely will not start to rebound until 2024 at the earliest. So if you're a short-term investor, it's fine. If you want to get out, it makes total sense because ZIM stock might continue to drop over the next 6 months. If you're a long-term investor, then maybe consider using this downturn to buy more stocks so that when things turn around, you can make a lot of money. It's important to note that ZIM's dividend policy remains unchanged, according to which the company intends to distribute 30 to 50% of its annual net income as dividend to shareholders. That means that when things turn around with ZIM, the dividends are going to be huge and they're going to way more than make up for the losses that we're currently experiencing in the stock price. Of course, in accordance with its dividend policy and in light of the net loss recorded in the second quarter of 2023, the company will not distribute a dividend to shareholders based on its second quarter results. So no dividend this quarter, obviously, but hopefully when things turn around in 2024, we will see those dividends return. Now, Cisco also reported earnings today, and Cisco was one of the last major companies to report earnings at the end of the earnings season. We still have Walmart tomorrow, but after that, earnings season is pretty much over. Cisco reported Q4 2023 results. Revenue came in at $15.2 billion, which was an increase of 16% year over year. Earnings per share were at 97 cents, which was an increase of 43% year over year. So incredible earnings beat from Cisco, and the stock was up about 2.7% after hours. Target also reported earnings on Wednesday, and unfortunately, they slashed their full-year forecast as the retailer struggles to win over thrifty shoppers. And I talked about this in yesterday's video, how Target has a bigger focus on goods and a smaller focus on groceries. And as a result, their revenues have been struggling lately. And I talked about how there was a good chance they would report bad revenues in this quarter. And in fact, they did. Yet, despite reporting bad revenue, earnings per share came in at $1.80 versus $1.39 expected, a huge beat on earnings. Revenue was a miss as expected. Revenue came in at $24.77 billion versus $25.16 billion expected. So how was Target able to have a huge earnings beat despite the fact that their revenue went down? Well, along with company-specific actions, Target said it also benefited from lower markdowns, cheaper freight costs, reduced supply chain and online fulfillment expenses, and increased retail prices. So basically, everything went right for Target, despite the fact that less people are shopping at Target and their revenue is down. All of their expenses went down by more than the revenue went down. We've talked about this so much before on the channel, how a company can increase earnings by increasing revenue, but they could also increase earnings by decreasing costs. And in the case of Target, they significantly increased earnings by significantly decreasing their costs. As a result of the huge earnings beat, Target was up about 3% on the day. And while shoppers are spending less at Target, shoppers are spending more at TJX. TJX companies include TJ Maxx, Marshalls, and Home Goods. TJ Maxx reported an earnings per share of 85 cents versus 77 cents expected, and the reported revenue of $12.76 billion versus $12.45 billion expected. That was an 8% increase in year-over-year revenue. TJX was up about 4% on the day on their huge earnings beat. And based upon the earnings beat from both Target and TJX, I would guess that Walmart will probably have a huge earnings beat tomorrow as well. Of course, there's no guarantees, but based upon the fact that other retailers are having some pretty nice earnings beat, I would expect Walmart to have a pretty good earnings beat as well. Now, speaking about all these retailers and consumer spending habits, one article I found very interesting today is that Kava and Sweet Garden are seeing their delivery orders fall as customers pick up their own food. Now, why would customers pick up their own food instead of just having it delivered? Well, it really speaks large volumes to the overall economy and the fact that consumers are really struggling right now. Consumers don't want to give up their food from restaurants, but they're finding ways to cut back on the cost of that food. Delivery orders are typically more expensive thanks to added fees and tips for delivery drivers. Sometimes restaurants even charge more for the food itself to offset the often hefty commission fees that they pay third-party delivery services such as Uber and DoorDash. All of that makes ordering food for pickup an easy way to save money. And just how bad are consumers struggling? Well, JP Morgan's CEO predicted that American households would exhaust their pandemic savings around the end of this year, paving a way for a slump in consumer spending and an economic slowdown in 2024. And as we see consumer spending continue to slow down and consumers continue to run out of savings and max out credit cards, this is all leading to much higher chances of a recession in 2024. And it's one of the reasons why the stock market continues to sell off. Now, today, we not only got the economic news, we also got the Fed meeting minutes from their meeting in July. And that also scared the stock market a little bit. The FOMC July meeting minutes showed that Fed officials see upside risks to inflation, possibly leading to more rate hikes. Federal Reserve officials expressed concern at their most recent meeting about the pace of inflation and said more rate hikes could be necessary in the future unless conditions change. Discussions showed that most members worry that the inflation fight is far from over and could require additional tightening action. Now, despite most Fed officials thinking that we're going to have to continue to raise interest rates, there are at least some Fed officials who are turning cautious about raising rates too high. And this disagreement among Fed officials is leading to a lot of uncertainty about the future direction of policy for the FOMC meetings. So while the FOMC does appear to be a little bit uncertain about how much they're going to continue to raise interest rates by in the future, the stock market does appear to be waking up to the reality that the Fed will have to continue to raise interest rates, that they will keep rates elevated for longer than the stock market was hoping. And the stock market also appears to be waking up to the reality that we are most likely going to get a downturn in the economy. Whether or not we call it a recession or not is yet to be seen. But we will probably get a downturn in the economy starting in 2024. And seeing as how the stock market is forward looking, at least 6 months to a year out, that is around the time where this downturn in the market is most likely supposed to occur. And that is why we are starting to see the stock market sell off now. So as the stock market sells off, whether you want to buy the dip or whether you want to perhaps buy some put options and take advantage of the downturn in the market in the short term, there are ways to do that with a lot of the brokers that are available worldwide. With both Webull and Moomoo, you can buy stocks and options. And I'm really happy to announce that Webull is now available in the UK. Just be aware that your investment is at risk and you could lose money that you invest. In the UK, if you want to get some free stocks, you can open an account with Webull using my link in the description of this video. And options trading is coming to Webull in the UK very, very soon. Of course, if you're here in the United States, you can get free stocks. You can get up to 12 free stocks with Moomoo plus $50 cash. You just have to keep your deposit in the account for at least 60 days. And with Webull, you can get up to 12 free stocks as well. And Moomoo is also available in Canada if you're in Canada, and also if you're in Australia. So pretty much anywhere you're at, you can get either Webull or Moomoo. Just check the description of this video or the first comment below for links to get your free stocks and to sign up and start trading today. I saw somebody in the comment section yesterday saying that he was planning on starting to trade soon, but he hadn't actually gotten started. The best time to start is right now. And the best time to buy stocks is during a downturn in the market like we're experiencing right now, because you're able to buy stocks at a discount. There is no better time to invest than right now. You can get started with as little as $100. So use my link in the description below, deposit $100, just keep that money in your account for at least 60 days, start buying some stocks and start building wealth, start getting rich. And if you want some help on what stocks to buy, on Friday, we're going to have an update on the Millionaire Club portfolio, and we're going to go through all of our stocks. We're going to find some new stocks to buy, and it's going to give you some incredible insight into what stocks to buy and how to make money in this stock market. Now, if you missed yesterday's video where I explained a little bit more detail about why the stock market is going down, make sure you watch the last video that I uploaded here.